Greetings, Jonathan. Camarda, as we roll through Q3 and the roughest month of the year historically, September. So, what are we looking at from a global macro standpoint? Well, we will definitely check it out with a little backdrop here, ode to my days in the '90s working in Manhattan. So, I got a New York state of mind, and we will start with the S&P 500. And we'll get into some of the deeper fundamentals here. So you can see the market has again continued to trudge up since the April lows. I'm going to come back to these charts here for a few comparisons, but I do want to get into the sectors more specifically. Over the last few months, again, no surprise, right? Technologies, discretionaries, as you can see with the yellow and pink lines here, have been the outperformers. Energy, as you might have noticed, last few months, right, going up along with discretionaries. On the weaker half, again, real estate and consumer staples. Last time we spoke, same thing, especially consumer staples were the laggards, over the last 3 months. Now, as we look at a closer time period, again, we've seen staples and real estate step up a little bit during this time of year, not too surprising, although our leaders still are discretionaries, communications, technologies have taken a step back with financials holding in. So it has been a little bit of a scramble. Now, year to date, again, our consumer communications, industrials, and technologies, the top performers, with again industrials just slightly fading here over the most recent time period. Now, as we start to dig deep into what is driving the market here, more specifically, I'm going to go quarter to date, started off there. Small caps have been outperforming. They've seen that, especially with the hint that the Fed may ease here in September. We shall see. But you see small cap value and growth outperforming its larger and mid cap brethren, really quarter to date over the last, let's just call it a couple of months. Over the last 3 months, again, the same growth has been a driver. Small cap across the board outperforming. Year to date, we still see large cap and momentum outperformers, but that momentum has faded with small caps taking the lead. We shall see if it's just a short-term reversion to the mean, but that's an interesting thing to keep an eye on. Again, if we look Q to Q GDP, again, the U.S. still looking pretty attractive year to year. Again, 3.3 and 2% respectively there from that standpoint. Now, we are looking at, when we start talking at jobless rates, we are starting looking at job openings being less than those folks that are looking for them. And of course, the labor market has looked weaker, which is why, again, and in Jackson Hole, that the Fed tipped its cap that, again, that there may be a rate cut in September. The lean is a quarter point, 50 points off the table. Maybe not, but the lean is 25 basis points on that. We start to look, in the credit markets, we see outperformance again, still in high yield and high quality corporates, outperforming. And then along the way in the treasuries, really, again, along the yield curve, it has been an interesting viewpoint. So from there, we're going to jump to look at where we see treasury yields, right? So where we see treasury yields from that standpoint, you can see here how steep, right? The long end of the curve, 10 years plus, we're looking in the upper fours to low fives. And again, as we get into the lower duration, here we're into, again, the belly of the curve in the threes. And again, shorter duration, still you're getting a pretty attractive yield in the fours. Now, just to show you how much that's changed just over the last, several months, go back to last year, you can see the curve not that steep, right? Just what a change is made just going into this year. As you can see, the long end of the curve was just in the low fours versus the high fours. And then, of course, we did have a more attractive yield there in the short term. The belly was still pretty low. And then going back, of course, when we're talking about in the height of, the inflationary concerns and as such, we went back to 23 and as such, we had that inverted yield curve, right? Just take you back to what that meant, right? So that's the delineation. You hear these terms, but you can see the visual. Look at the difference. The high yields we were getting on a shorter end, very low when outlook was more dire. And now we see the opposite as we chug along here to, again, where we are right now into September 25. So really, as you look at that, really to drive that point home, and what that means is, again, more economic, constructive thinking on the long term when you see higher rates on those longer duration, areas of the curve. But at the same time, we do have to watch to see again, the inflationary situation. So again, as we look right here, you can see again the current, that's the blue, right? Again, the long end is higher than it was just even a year ago, which makes sense. We kind of looked at that going back a couple of years, but you can see the real fissure between those two yields. And then, really the Mendoza line, so to speak, here is a 3-year, pretty much is the same as it was last year. And then you start to see again yields lower on the short end, which we saw as well, even going back 2 years, you're getting less now juice for the squeeze on the short end of the yield curve. So the Fed is balancing, all the editorials aside, the inflation picture with the jobs picture, and labor is weakening. Technologies and financials have been somewhat of an exception, and a lot of stuff happening in those areas. But overall, the job openings have showed weakening there in the jolts in July. So now as we start to look at where we're on the forex side, right, we start to look at the currencies, of course, the USD. And again, you see the USD, US dollar, again, really just since, midsummer has strengthened versus, again, the pound, the euro, right? You can see this upward trajectory here, and the yen, we said, and also the CAD, Canadian dollar, as well. Now, again, that's just over the last few months and as such. Longer term trend, again, you can see the euro, pound, and the yen versus the dollar has been strong for those currencies versus the dollar, but we've seen a little bit of a line in the sand where the US dollar is stiffening up there and getting a little bit relatively strong. Again, that makes sense as we look at the long end of the yield curve showing strength, and also makes sense, right, when we start to look at the regime, on the other side of the pond, if you will, where we've had, again, more loosened monetary policy versus the more tight policy here, but we shall see again how long that continues. So as we look across, those areas, the only thing I was going to say again, and then yield spreads have shown the same thing. We have tightened yield spreads now, which means again the difference between what you're getting on risky bonds versus risk-free bonds. When things get really worrisome out there, you're generally looking at a wider spread, and you're to be compensated for the more risky fixed income instruments, where the tighter spread says, pretty much you're not going to get paid too much more because we don't really perceive a lot of risk. So again, we shall see if there's a rubber band effect there. Now, as we finish up, just looking at the charts, everyone's favorite, the charts, the S&P 500. If you look again, how we look at where money should be located, we look at an S&P 500 versus the bond market. Again, in an upward trajectory, we start to look at risk. The Nasdaq versus the S&P, just to look at risk appetite, right? And that would be the QQQ. Forgot a Q there, right? Got to mind your P's and Q's. You can see again in September, this is an area where we are starting to see some of that seasonal weakness, right? Almost meteorological here. We see the storm clouds coming in with the Nasdaq, which was stronger since April than the S&P. You see that as a relative strength line is now starting to dissipate. So we obviously want to watch that. And some of your more tactical strategies, you've seen some defense there, certainly like in an all-stars to be specific. Now we start to look at the bond market versus the gold market. Gold has slowed down a little bit, but still not so slow where it's been more attractive than the fixed income area. And then we start to look again at S&P 500 versus gold. Again, you can see where, again, the seasonal weakness, right? S&P was trending up, not a steep incline, but definitely up relatively, has now dropped back. Gold has taken the rein there. Now, the other thing, too, that we start to look at is, your Bitcoin digital assets outperforming gold just like the market and starting to drop back versus gold. Makes sense, right? Because September is hurricane season, so to speak, in the financial markets, as well as us down here in the Southeast. For folks around the nation, we all have our weather issues, but down here, this is tis the season. Now I'll finish up by just looking at and driving home the point there. When we start to look at large caps versus small caps, you can see here the S&P versus the Russell 2000, much beleaguered Russell 2000, which has basically had its face in the dirt for so long we can't even remember when it was able to breathe. But you're starting to see some outperformance there. Could it be the Fed tipping its hand, tipping the cap that rates will come down? Obviously, small caps who borrow more, right, depend more on leverage, certainly would, incline at a steeper pace if that was the case. Now we start to look at, the comparison here of just mid caps and as such in that situation, then we're going to start to see again, kind of down the middle, and just kind of drive home that point as we finish up here. You start to look at where mid caps are in the whole thing. They have actually dropped below year to date small caps, right, and then quarter to date they have actually snuck up barbelling around large caps. But again, small caps have been the leading, capitalization size, which makes sense. Also, IPOs, initial public offerings, which is private equity, right? IPOs is one of the way private equity ends. They come in, they change, they shift, and then they issue new stock, right? And hedge funds as well, and buybacks are outperforming in that area, which again tends to be looking at again constructive biases, if you will, biases, in the markets. And so that's what we have for now. We are proceeding with caution. Don't want to necessarily hit the brake pedals, because as the Fed decreases rates, if they do, high probability, the sum is already baked into the cake. But again, we may have an unusual bounce in September into October, November, or again, usually late October into November is when you usually have your strongest momentum. So we shall see. If you have any questions, of course, about your own risk tolerance, you can certainly discuss that with your private wealth advisor to go into more detail and granularity. That being said, hopefully your football teams are winning. It's been too long. I know you missed me. You don't have to tell me. Jonathan Camarda signing out. We'll talk to you soon. Bye.